The Federal Reserve, under Chairman Jerome Powell, recently decided to keep interest rates unchanged. This decision highlights the Fed's delicate balancing act of taming inflation without derailing economic growth. Current rates are at a range of 5.25 to 5.5%, the highest in over 2 decades. Powell emphasized the Fed's dedication to reining in inflation, currently around 3%, above the target of 2%. The global economic landscape adds to the complexity of the Fed's task. The war in Ukraine and geopolitical tensions make predicting inflation difficult. The Fed's GDP growth projections for 2025 have been revised downward to 1.7%. Powell hinted at potential rate cuts later this year to support the economy if needed. The Fed is cautious of raising rates too aggressively, which could stifle investment and risk recession. The Fed's next move will depend on data, closely monitoring inflation, employment, and economic growth. Looming large over the current economic landscape is the lingering impact of former President Trump's trade policies, particularly the tariffs imposed on goods imported from China. These tariffs, while intended to protect American industries and jobs, have injected a significant degree of uncertainty into the global trading system. This uncertainty has contributed to rising prices for businesses and consumers alike, further fueling inflationary pressures. The tariffs have also disrupted supply chains, forcing businesses to scramble for alternative sources of materials and components. This disruption has led to delays and increased costs, ultimately impacting consumers through higher prices and limited product availability. While the full extent of the tariffs' impact is still unfolding, it is undeniable that they have added another layer of complexity to the Fed's efforts to manage inflation and promote stable economic growth. Moreover, the tariffs have strained relationships with key trading partners, creating a climate of uncertainty and potentially hindering future economic cooperation. This tension comes at a time when global cooperation is crucial to address shared challenges, such as climate change and supply chain vulnerabilities. The Biden administration has inherited this complex web of tariffs and is now tasked with navigating the delicate process of unwinding them without causing further economic disruption. The initial reaction on Wall Street to the Fed's decision was positive, with the Dow Jones surging over 400 points. This rally suggests confidence in the U.S. economy. However, a closer look reveals a more nuanced picture. Bond yields remained flat, indicating concerns about future growth. Certain sectors like technology saw muted gains, showing investor caution. This mixed bag of signals underscores ongoing economic uncertainty. Looking ahead, the U.S. economy faces a multitude of challenges, both domestically and globally. Inflation, while showing signs of moderating, remains stubbornly high, and the Fed's commitment to bringing it back down to its 2% target will likely require further interest rate hikes, potentially slowing economic growth. The labor market, while still strong, is showing early signs of softening, with job growth slowing and unemployment ticking up slightly. Consumer and business confidence has also waned in recent months, reflecting concerns about inflation, rising interest rates, and the overall economic outlook. This decline in confidence could translate into reduced spending and investment, further dampening economic activity. Globally, the war in Ukraine, persistent supply chain bottlenecks, and geopolitical tensions continue to pose significant risks, adding to the uncertainty surrounding the economic outlook. The Fed, for its part, faces the unenviable task of navigating this complex and uncertain landscape, balancing the need to control inflation with the imperative to support economic growth. The path forward is likely to be bumpy, with potential for volatility in financial markets and the broader economy. Policymakers will need to remain nimble and responsive, adjusting course as needed to address evolving economic conditions. The Federal Reserve's decision to hold interest rates steady reflects the delicate balancing act facing policymakers as they grapple with stubbornly high inflation, lingering uncertainties from past trade policies, and a global economic outlook clouded by geopolitical tensions. While the U.S. economy has shown remarkable resilience, the path ahead remains fraught with challenges. The Fed's commitment to taming inflation, while essential, carries the risk of slowing economic growth and potentially tipping the economy into a recession. The legacy of Trump's tariffs continues to cast a long shadow, contributing to inflationary pressures and adding complexity to the economic landscape. The market's response to the Fed's decision, while initially positive, reveals underlying concerns about the future trajectory of the economy. Navigating this uncertain terrain will require careful monitoring of economic data, a willingness to adjust course as needed, and a commitment to clear and consistent communication from policymakers. The coming months will be crucial in determining whether the Fed can successfully engineer a soft landing for the economy, avoiding both runaway inflation and a painful recession.